Therefore, like everything else, there should be some key controls regarding fixed assets. Number one is probably written policies. Do you have an acquisition policy, disposal policy? Are there guidelines for life expectancies, how we calculate our valuations? Hopefully your employees are following these policies. There normally is a capital plan or some sort of formal budgeting process of what we expect to spend on capital projects. You want to limit access to physical assets as much as possible. I mean, again, a lot of these are going to be just buildings or things that people are going to walk across and be near every day. But to protect your company, that's why you can't be in the building unless you're an employee of the company, let's say. So these are ways that physical access can help control the assets and protect the assets. Periodic comparisons of the physical assets to subsidiary assets. Do the assets exist? Do we still have those assets? Are they still out there? And it's important that we compare that subsidiary ledger to the general ledger, because there are a lot of systems where you'll have a general ledger amount for fixed asset, and then you might have a subsidiary ledger. It could be connected. So let's say they're connected, but you have the ability to do journal entries at the general ledger level without affecting the subsidiary ledger. So the ledger might have all the details of all the purchases and whatnot, but if you have the ability to kind of go over the top of that and do a direct entry to accounts in the general ledger, those two might not balance. For systems that don't have a subsidiary ledger, sometimes they will keep all of those items on an Excel spreadsheet. You want to make sure that Excel spreadsheet ties out to that general ledger. And again, another reason why analyzing that Excel spreadsheet to make sure that there aren't hidden things, miscalculations in that spreadsheet are very important. So that's why separate fixed asset systems can be used, but they should also be reconciled to that general balance also. Some of the analytical review or planning ratio analysis you might do is you'll compare the useful lives used by the client against industry standards. You've got that policy in line, you'll see what they're using. Does it make sense? You can review disposals for proper recording of gains and losses. You can compare asset and related expense account balances with prior years to identify any major challenges. Again, if someone's trying to hide a capital expense, they might hide it in the operating expenses under repairs and maintenance or something like that. So you should see some major fluctuation in these accounts in which there might be some reporting errors. So you want to understand those significant changes. If you divide depreciation by the tangible fixed assets and investigate any significant fluctuation within prior years. So again, depreciation divided by fixed assets. Next, divide repairs and maintenance expense over depreciable fixed assets and note any significant fluctuations from prior years. Because in theory, depreciation over fixed assets should generally go down in the later years. If the asset becomes fully depreciated, we would see less depreciation. Or if you're using an aggressive tax approach, you'll see higher depreciation in the beginning years and less in the latter years. So I would kind of expect that depreciation over fixed assets would go down if we haven't had any major fixed asset purchases. Whereas repairs and maintenance expense, I would see the opposite. I would see if we've got these fixed assets for a while, I should see that repairs and maintenance expense divided by fixed assets start to go up a little. So I will see some trends in how those costs react to this ratio, but it's good to know your client and know what you're expecting to see there. If they have made some major purchases, then that would change how you would look at that ratio. So again, control tests, substantive tests, some of them seem very similar, but control tests, in essence, you're going to just see, are the authorizations out there? You know, there might be some new assets that you bought in that period for the audit period. Did they get board approvals? Maybe was there business case approvals or procurement authorizations? These are standard controls that should be in place related to buying fixed assets, so they should be there. You can review that documentation and against the capitalization policy of the company. How we're classifying it as to what type of asset, how we valuing it, what's the useful life, is there a salvage value, is there a process for that in place, and is it being executed properly? And is the client actually doing fixed asset count checks regularly? Are they looking to see if that actual physical asset sits out there, especially in larger companies where they'll have subsidiaries, again, geographical locations, that they should just double check those things on a regular basis. Review those disclosures for compliance to any accounting standards. So in general, it looks like they've got a fixed asset process in place. When we get to the substantive tests for fixed assets, we're going to select a sample of all the fixed assets. We're going to make sure that those assets exist. Are they out there? Make sure they haven't been sold, disposed of, retired, traded in, stolen, whatever have you, but you're going to look for existence. You're looking at the title of those assets. Make sure the client rightfully owns that property. Make sure there haven't been any changes to the ownership rights, because maybe there's a situation where you've got a client that has financial difficulties, and one of the things they might do is sell their building and then lease it back. So that way they get some sort of cash inflow from the sale of the building, and then they turn around and lease it back from that company with maybe the intention of buying it back at the end. So these are scenarios that could potentially happen with the uh, physical assets or the fixed assets, so that you make sure you're on top of that from a reporting standpoint. The valuation of it, the asset itself, has it been correctly valued? Look at invoices, make sure that it makes sense. Look at contracts, whatever documentation has created the value for that asset that you're sampling, make sure it's there. Check and verify the depreciation method that has been calculated. Has it been done correctly? Has it been carried out properly? Has it not been altered? Those are part of the valuation process of checking a fixed asset. Then again, verify that subledger of fixed asset. Make sure it balances to the general ledger. Examine any journal entries or unexpected transaction types that have found their way onto the general ledger. Like, you should see purchases going into the general ledger. But if you see some other oddball transaction or just a general journal entry that just seems oddly put into that fixed asset account, you got to examine that and look at the details for that. Look at the current period additions and disposals. Make sure that makes sense. So you got the beginning assets, you have some additions, you add that in there, you subtract out the disposals. That should, in essence and simplicity, equal your ending fixed asset balance. If it doesn't, you have something that you probably have to look into further. And then finally, again, recalculate all your depreciation and accumulated depreciation. Make sure it makes a sense.